Coming up, we're going to be looking at the lenders that have changed their interest rates this week. We're also going to be taking a look at the lenders that have changed their lending criteria this week and what that means for people that are applying for mortgages. Also, we're going to be taking a look at the key economic data from this week, including the Bank of England base rate change and GDP data along with wage data. And then lastly, we're going to be taking a look at the most up-to-date swap rate chart and indicate what that's going to mean going forwards for mortgage rates in general. Hello, everybody, and welcome to the UK Mortgage Market Insights for the weekend in the 15th of December 2023. I hope you're all well. So first up this week, we're going to have a look at the lender criteria changes. And first of all, we're going to have a look at the Skipton. They've now introduced a policy where they're happy to lend up to 95% on new build flats, which is great news. Nationwide have amended their visa policy, so now people can apply for a mortgage if they don't have any indefinite leave to remain, as long as they've got 12 months remaining on their visa at the point of application, which is also good news. Santander have improved their residential affordability calculations, meaning that people can borrow more money and more people can get mortgages through them. And they've also improved their buy-to-let stress testing criteria, making some reductions, meaning that more people can borrow on the buy-to-let side of things, and potentially landlords can borrow a bit more money through Santander. Virgin have now increased their maximum mortgage term to 40 years. And they've also improved affordability criteria for people that are taking fixed rates of 5 years or more, which is great news. And then lastly, Metro Bank have made some improvements to their self-employed criteria. They're now happy to accept an accountant certificate for mortgage applications under £1 million, and they've reduced the minimum trading period to 2 years rather than 3 for those self-employed people. On the employed side of things, they've made the change where there is now no minimum term required for employment as long as they can see your first payslip. So as well as the lenders reducing interest rates, they're also improving their lending criteria, meaning that more mortgages are available to more people, which is great news. So this week, the Office for National Statistics released the latest wage growth data. And the report shows that annual growth in regular earnings for August to October 23 was 7.3%. That's excluding bonuses. And this is strong, but not as high as it was in previous periods. For example, previously it was 7.7%. Annual growth in employees' average earnings, including bonuses, was 7.2% for August to October 23, and previously it was 7.9%. And adjusted for inflation, annual growth in real terms, including owner-occupied housing costs, total pay rose by 1.3% in August to October, and in the previous period it was 1.5%. So these numbers that we're seeing are now compared to exactly 1 year ago, which actually means that the numbers could be a little bit misleading because, as we all know, this year we've seen a lot of protests and strikes and pushes for wage increases across the board, mainly caused by the increased cost of living and rising inflation. So because we're comparing these numbers to a year ago when we were starting from a really low base of wages, the numbers are skewed, and going forwards, it's potentially possible that we might actually see real wages decreasing further, which basically means that people haven't got as much money in their pockets to go out and spend in the general economy. So next, we're going to take a look at the Bank of England's mortgage lending data for the third quarter of 2023. So the value of mortgage advances increased by 18.6% from the previous quarter, but it was actually 27.6% lower than a year ago. This data is showing mortgages that were agreed several months ago, so before the summer period, when rates were actually lower. The value of mortgage lending agreed, so that's mortgages that are currently agreed to be lent on, but yet the money hasn't been released. It will be released in the next few months. That is down by a massive 16.5% on a previous quarter and is a huge 41.4% lower than a year ago. That shows that what a difficult year it has been in the mortgage lending market this year. People have just not been buying. The value of mortgages with arrears has sadly increased by 11.4% from the previous quarter. And again, a huge 44% increase from a year ago. So people really are struggling out there, which is something that we have been saying for a while now. And then lastly, in this section, advances for buy-to-let lending decreased from the previous quarter to 7.5%. And it now sits at the lowest level since quarter 3 in 2010, which is just massive. And it's 5% lower than it was 12 months ago. So again, as we've seen, a decrease in the buy-to-let lending. And this has been mainly caused by the fact that the stress tests that lenders use have been so strict and they're based off higher interest rates. So, also this week, the Office for National Statistics released the latest GDP data. So, it's been estimated that the monthly GDP data shows no growth in the 3 months to October 2023, and it's estimated to have fallen by 0.3% in October after seeing a slight growth of 0.2% in September. Services output fell 0.2% and was the main contributor for this fall in GDP growth. Production output fell by 0.8% after widespread declines in manufacturing, and construction fell by 0.5% in October after seeing growth of 0.4% in September. Overall, this is a bleak picture and it's not good news for the economy. There are signs that we could be heading towards a recession. So, what that's going to mean for mortgage rates and things going forwards, we will come on to later when we talk about the swap rates and the lender rate reductions as well. And then, of course, the big story from this week was the Bank of England meeting yesterday, where the Monetary Policy Committee decided to keep the interest rate on hold at 5.25%. So, as we all know, inflation has been high, and the whole purpose of increasing the interest rates and keeping them there has been to try and tackle that inflation until it hits the target of 2%. So inflation is currently sat at 4.6%, which is still a bit high, hence keeping the rate on hold at this meeting. The next set of inflation data is released next Monday, and it's expected at that point in time that we will hopefully see that inflation has dropped a little bit further. All the data is showing that the economy is stalling, that people are genuinely struggling with their bills and the cost of day-to-day living, and worse still, more than 1.4 million people next year are going to be coming off low fixed rates onto higher fixed rates. The cost of living struggles are going to continue, and as people don't have much money to spend, there is a real risk that we are heading into a recession, and that is if we aren't already in one. Because of all this troubled data, it really does amaze me that 3 people on the MPC yesterday voted to increase rates. This clearly shows that they're so far withdrawn from the normal general public, and they have absolutely no clue what is going on in businesses and households up and down the UK. It really is bizarre. In fact, Andrew Bailey was also interviewed recently, and he openly said he doesn't have a mortgage. I mean, I suspect that most of the members of the MPC don't have mortgages as well, which is partially why I think we're starting to see some of these crazy decisions with the interest rates. They have no idea of what really is going on. For what it's worth, I think it's time that the MPC was changed. I think we need to get some new people on there. The people that are on there currently are very wealthy people, probably don't have mortgages or other debts, so they've not got a real clue of how people are struggling. If we had a wider representation of the general UK public on there, then things might be a little bit different. Love to know your thoughts though, so please do leave them in the comments. So let's take a look at the latest swap rate charts. And at the time of recording, that was from 11:30 p.m. yesterday evening, which was the 14th of December. And this just makes fantastic reading. The key numbers that we generally tend to look at are the 1, 2, and the 5-year rates. You can see that the current column for 1-year rates is a little bit higher than it was a year ago. And this is because this is a general feeling of what interest rates are going to be doing over the course of the next year. And there's talk from the Bank of England that they're going to keep rates higher for longer. But personally, I think that that's going to change slightly. If we look at the 2-year, that's not too far away from where it was exactly a year ago. And importantly, the 5-year is now actually lower than it was exactly a year ago. And this was the time last year when we were starting to see lenders really reducing their rates and bring out some good products. Next, we are going to be looking at the lender rate reductions this week, but this swap rate chart does show why we're seeing those rate reductions from lenders coming thick and fast. I don't think it's going to be long before we see a 5-year fixed rate starting with a 3, which is just going to be fantastic news for the mortgage market. So the swap rate chart is looking positive. It indicates why lenders are reducing their rates. This is great news. As we head out the year, swap rates reducing just only means one thing, in my opinion, and that is going to be a good start to next year. That then brings us on to the bit that everybody wants to know, and that's the lenders that have reduced their mortgage rates this week. The key lenders this week are as follows: the Nottingham Building Society, Generation Home, Skipton Building Society, Digital Mortgages by Atom Bank, Foundation Home Loans, HSBC, Empowered, Virgin, Clydesdale, Bank of Ireland for their switcher products, TSB, and the Cooperative Bank. So a vast variety of lenders reducing their rates. So positive news and a positive feeling in the mortgage market. So if you're watching this video on Instagram or Facebook, then I will try to put links to the relevant articles in the comments, as I will do the same for TikTok. If you're watching on YouTube, then it's likely that I will have put the links within the video description. I'd also like to take the opportunity to remind you that every Tuesday and every Thursday between 6:30 and 8:30, I am on TikTok live answering questions on anything mortgage, property, and economy related. As always, I really do appreciate your support in the channel. Thank you so much. If you're not subscribed to me, then please do subscribe. That just leaves me to say have a great weekend, and I'll see you next week. Take care.